At 3 a.m., on a quiet Tuesday, a $15 billion loan agreement slipped into the SEC filing stack, hidden behind Starlink's satellite contracts, and no regulator noticed. The document listed a single line, $15 billion secured by Starlink assets, then vanished into the margins. What if that hidden debt can't be serviced? Inside the cramped conference room of a New York hedge fund, senior analysts stared at the same line, eyes widening as the numbers flickered on their screens. The room, usually a steady hum of coffee cups and market chatter, fell silent. A junior trader whispered, "If Starlink defaults, the ripple could hit every tech equity we own." The words hung in the air, a warning without a name. Across the Atlantic, a regulator in Washington received a terse email. "Unusual loan structure detected, review required." The message was brief, but the attachment it referenced was anything but. The email's subject line reads, "Starlink debt, immediate attention." Meanwhile, a satellite ground station in Texas pinged erratically, its data stream stuttering as the network strained under demand. Engineers, unaware of the financial undercurrents, blamed a software glitch. In reality, the strain stemmed from a financial promise that had never been fully disclosed to the market. The scene repeats worldwide, investors, regulators, and engineers all feeling the tremor of a debt that never entered public consciousness. The question lingers, how deep does the hidden $15 billion run, and who will feel the fallout when it surfaces? I've spent over a decade tracking hidden liabilities in tech finance. Tesla's 2023 10K reveals $5.5 billion in debt secured by Starlink assets, with no independent valuation confirming asset-liability alignment. Source: SEC filing. The Wall Street Journal's investigation uncovered that SpaceX has amassed $15 billion in loans tied directly to Starlink, and critics are already questioning the sustainability of its revenue projections. Source: WSJ. Starlink's revenue model hinges on a subscription service sold to consumers and enterprises, bundled with the promise of low-latency broadband from a constellation of low Earth orbit satellites. The service generates roughly $2 billion in annual revenue, a figure that, while growing, still falls short of covering the interest on its massive debt load. Source: Bloomberg analysis shows debt-to-equity ratio at 3.2 times, far exceeding industry norms for infrastructure projects. The stakes extend far beyond SpaceX's balance sheet. The International Monetary Fund warned that private debt overhang in technology sectors, where valuations are disconnected from cash flows, poses a systemic risk to global markets. Source: IMF. If Starlink's cash flow can't meet its loan covenants, lenders could trigger cross-default provisions, pulling capital from other high-growth tech firms that rely on similar financing structures. A cascade of forced asset sales would depress equity valuations across the board, eroding investor confidence in the broader market. Reuters reported that SpaceX's 2023 bond issuance carried a 7.5% yield, a clear signal that investors were pricing in heightened liquidity concerns. Source: Reuters. The elevated yield reflects a market already uneasy about the company's ability to service its obligations without jeopardizing its core operations. Consider the mechanics. A default on the $15 billion loan would force lenders to seize Starlink's satellite assets. Those assets, while technologically valuable, are not easily liquidated for cash. The resulting shortfall would cascade through the loan syndicates, hitting banks, pension funds, and sovereign wealth funds that hold exposure to SpaceX's debt instruments. Equities tied to the broader tech ecosystem would feel the pressure. Hedge funds with long positions in semiconductor manufacturers, cloud providers, and AI startups could see margin calls as the market reprices risk. The fallout would echo on Wall Street, where indices are already sensitive to shifts in tech valuations. Moreover, the hidden nature of the debt amplifies the risk. Because the $15 billion figure is buried in footnotes and not highlighted in earnings releases, many investors remain unaware of the exposure. A sudden revelation would trigger a wave of sell-offs, amplifying volatility at a time when markets are already jittery over geopolitical tensions and tightening monetary policy. The potential for a global market crash is not speculative fiction. It stems from a concrete financial arrangement that, if mishandled, could destabilize the delicate balance of capital flowing into high-growth tech. The hidden debt is a silent time bomb, waiting for the moment when cash flow mismatches become impossible to bridge. In the next minutes, we'll unpack the loan structures, trace the money trail through the banks that underwrote the deals, and examine how a default could rewrite the rules of tech financing. I'm not a financial advisor. This content is for informational purposes only. The story begins with a balance sheet that looks ordinary at first glance: cash, assets, a line of debt. But hidden behind that line is a $15 billion web of loans tied directly to SpaceX's satellite arm, Starlink. The loan structure is simple enough to describe, yet complex enough to obscure risk. SpaceX has issued senior secured notes, each backed by Starlink's ground infrastructure and orbital assets. Those notes carry an interest rate of 7.5%, the same yield reported when the company tapped the bond market in late 2023. Source: Reuters. What makes the arrangement unusual is the lack of an independent valuation of the collateral. Tesla's 2023 10K notes that $5.5 billion of debt is secured by Starlink assets, with no independent valuation confirming asset liability alignment. Source: SEC. In other words, the lenders are relying on internal estimates that have never been audited by a third party. The financing terms also include a revolving credit facility that can be drawn down in tranches of up to $2 billion. Each tranche is subject to a covenant that requires Starlink's projected cash flow to meet a 1.2 times coverage ratio. Because the projection methodology is not disclosed, investors cannot verify whether the covenant is truly protective or merely a paper shield. Accounting practices further mask the underlying exposure. SpaceX reports the Starlink loans under long-term debt while classifying the associated assets as property, plant, and equipment. This pairing inflates the asset side of the balance sheet without reflecting the volatility of satellite revenue streams. Bloomberg's deep dive analysis shows Starlink's debt-to-equity ratio at 3.2 times, a figure that dwarfs the typical 0.5–0.8 times range for comparable infrastructure projects. Source: Bloomberg. The ratio alone tells a story of leverage that would be alarming for any utility, yet the narrative is softened by the way the debt is presented. The accounting tricks extend to revenue recognition. Starlink's subscription income is booked on a net present value basis, smoothing out the inherent seasonality of launch cycles. Critics argue that this method spreads future cash receipts across the current period, artificially bolstering earnings and diluting the perception of risk. A Wall Street Journal investigation uncovered that the $15 billion in loans is predicated on revenue projections that assume a steady growth rate of 12% per year, an assumption not supported by any public traffic data. Source: WSJ. When the same analysts compare Starlink's projected cash flow to its debt service obligations, the coverage ratio drops to 0.9 times under a modest 5% slowdown scenario. Expert commentary underscores the systemic implications. The International Monetary Fund's World Economic Outlook warns of a private debt overhang in technology sectors, highlighting valuations that are disconnected from cash flows as a systemic risk to global markets. Source: IMF. Starlink's situation fits that description, a high leverage position supported by optimistic forecasts rather than proven earnings. Equity markets have already begun to price the risk. Analysts at major investment banks note that any downgrade in Starlink's credit rating would ripple through SpaceX's equity valuation because the parent company's balance sheet is tightly interwoven with the satellite business. In practice, a 0.5% rise in the yield on the senior notes would shave roughly $200 million off SpaceX's market cap, a figure that, while modest relative to the company's size, signals vulnerability. The linkage between debt and equity is not merely academic. When a company's capital structure leans heavily on debt, equity holders become the residual claimants. Any shortfall in cash flow first erodes the debt service before affecting shareholders. Because Starlink's debt is secured by assets whose market value is uncertain, the safety net for equity investors is thin. Moreover, the lack of an independent audit means that the risk assessment rests on internal models that can be adjusted to fit desired outcomes. When those models are the same ones used to justify the 7.5% bond issuance, a conflict of interest emerges, a classic case of self-dealing that regulators have flagged in other high-leverage tech firms. To illustrate the market impact, Bloomberg plotted the spread between Starlink's secured bonds and comparable sovereign debt. The spread widened from 150 basis points in early 2023 to 260 basis points by the end of the year, reflecting growing investor anxiety. Source: Bloomberg. A widening spread is a direct market signal that lenders demand a higher risk premium, which in turn raises the cost of capital for the parent company. In a recent earnings call, SpaceX's CFO acknowledged that the debt profile is substantial, but we remain confident in our cash flow generation. He offered no concrete timeline for when the loans would be fully amortized, nor did he disclose the sensitivity analysis that underpins that confidence. The opacity extends to the covenants themselves. The 1.2 times coverage ratio is calculated on a projected EBITDA figure that excludes depreciation from satellite to orbiting, a cost that could become material as regulatory pressure to clear low-orbit debris increases. Putting the pieces together, the picture is one of a massive loan book, a valuation methodology that smooths risk, and market signals that the cost of that risk is rising. The IMF's warning about private debt overhang is not abstract theory. It is a lens through which the Starlink debt can be viewed as a potential shock absorber for the broader financial system. Investors and regulators should therefore watch three metrics closely: the debt-to-equity ratio, the bond yield spread, and the coverage covenant based on transparent cash flow calculations. If any of those metrics move outside historically safe boundaries, the ripple effect could spread far beyond the satellite industry, touching global equity markets that have already begun to factor Starlink's leverage into their pricing models. In short, the $15 billion loan structure, the accounting shortcuts that hide its true cost, and the market data linking it to equity valuations create a hidden threat, one that could surface if the underlying cash flows falter or if external pressures force a revaluation of the assets themselves. Understanding the mechanics of this debt, rather than accepting the headline figures at face value, is the first step toward assessing the systemic risk that Starlink now represents. The bell rings on a Wednesday morning and the market opens to an unexpected flash. A notice from SpaceX's trustee declares that Starlink's $15 billion of outstanding loans have entered technical default. Traders scramble, the ticker flashes Starlink default in red, and the first wave of sell orders erupts across the floor. Within minutes, the Nasdaq Composite slides 1.3%, pulled down by a cluster of satellite technology names that had ridden the orbital hype train. The immediate reaction mirrors the private debt overhang warning the IMF warned about earlier this year, where inflated valuations in tech become a flashpoint for market turbulence. Source: IMF World Economic Outlook, April 2024. Analysts trace the shock to the fact that Tesla's 2023 10K disclosed $5.5 billion in debt secured by Starlink assets, yet no independent valuation could confirm that the assets truly covered the liability. Source: SEC filing 2023. The lack of an external audit leaves investors staring at a black box, a massive liability, an unverified collateral pool, and a looming question of solvency. The default triggers an automatic downgrade of SpaceX's recently issued 2023 bonds, which were already priced at a steep 7.5% yield, a clear signal that investors were uneasy about liquidity and repayment capacity. Source: Reuters, Nov 15, 2023. As rating agencies slash the bonds, the yield spreads widen, and the bond market reacts like a chain reaction of falling dominoes. Across the exchange, ETFs that bundle high-growth tech infrastructure, such as the Global X Satellite Communications ETF SATL, and the iShares MSCI Global Tech ETF IXN, experience simultaneous outflows exceeding $2 billion in a single trading session. Their NAVs tumble as fund managers scramble to meet redemption requests, fearing that the Starlink exposure is a systemic crack in the portfolio's foundation. The ripple spreads beyond pure satellite firms. Companies that supply ground station hardware, launch service providers, and even cloud computing giants with Starlink-backed contracts see their shares dip 4–6% as investors reprice the risk of downstream revenue loss. The Bloomberg analysis of Starlink's debt-to-equity ratio, standing at 3.2 times, far above typical infrastructure benchmarks, now appears as a quantitative red flag that validates the market's panic. Source: Bloomberg 2024. Investors begin to unwind positions in related space tech equities, a move that amplifies the sell pressure on the broader technology sector. By the close, the S&P 500 Technology Index is down 2.1%, marking its steepest one-day decline since the 2020 pandemic sell-off. The cascading effect mirrors the domino scenario the WSJ outlined months earlier, where critics question the sustainability of Starlink's revenue projections amid a $15 billion loan structure. Source: Wall Street Journal 2023. Hedge funds that had bet on the sector's continued growth now face margin calls, forcing them to liquidate positions in unrelated tech stocks to raise cash. The forced sales create a feedback loop, dragging down valuations in areas as distant as semiconductors and artificial intelligence platforms, sectors that had no direct exposure to Starlink but are now caught in the contagion. Meanwhile, sovereign wealth funds and pension plans, which allocate a portion of their portfolios to high-yield tech bonds, reassess their risk models. The IMF's earlier warning about private debt overhang becomes a policy talking point at central banks worldwide, prompting a re-examination of capital adequacy buffers for institutions holding similar assets. Source: IMF World Economic Outlook, April 2024. The default also ignites a scramble for regulatory clarity. The SEC, already aware of the unsecured nature of the Starlink-backed debt, announces a fast-track review of collateral adequacy for future satellite financing deals. Market participants brace for tighter disclosure requirements, fearing that the lack of independent asset valuation highlighted in Tesla's filing could become a new compliance frontier. Source: SEC Filing 2023. As the day wanes, the narrative shifts from a singular corporate failure to a broader systemic risk. The intertwined web of satellite financing, high-yield bonds, and tech-focused ETFs demonstrates how a single default can destabilize an entire market segment. The $15 billion debt, once a footnote in SpaceX's growth story, now stands as a cautionary beacon for investors, regulators, and policymakers alike. In the final moments of the trading day, the Nasdaq's Tech Pulse graphic flashes a stark warning: systemic risk detected, reevaluate exposure. The message is unambiguous. The Starlink debt structure, with its inflated leverage and opaque asset valuation, has exposed a fault line that runs deep through global capital markets. The takeaway is clear: when a massive, poorly collateralized loan defaults, the shock is not contained within a single balance sheet. It reverberates through ETFs, drags down unrelated tech equities, triggers regulatory scrutiny, and forces a reassessment of the private debt paradigm that the IMF warned could become a global threat. The cascade has begun, and its aftershocks will shape market behavior for months, perhaps years, to come. The story ends not with a resolution, but with a question: how will the financial system adapt to a new era where satellite infrastructure debt can no longer be treated as an isolated gamble? The answer will define the next chapter of global markets. A stock ticker flashes red. A debt clock spins past $15 billion. Behind the sleek satellites and flashy marketing, Starlink's debt isn't just piling up, it's quietly rewriting the rules of risk. Tesla's latest 10K filing confirms $5.5 billion in debt backed by Starlink assets, and here's the catch: no independent valuation ensures those assets can cover the liability. Source: U.S. Securities and Exchange Commission 2023 10K filing. Bloomberg's deep dive shows Starlink's debt-to-equity ratio at 3.2x, more than triple what's normal for infrastructure projects. That's not a red flag, it's a warning siren. Source: Bloomberg 2024 debt structure analysis. The IMF isn't mincing words. A private debt overhang is building in tech sectors where valuations float free from cash flows. Starlink's 7.5% bond yield in 2023 wasn't a vote of confidence, it was a risk premium. Source: International Monetary Fund World Economic Outlook, April 2024. This isn't just SpaceX's problem, it's a systemic pressure point. When a single venture's debt load ripples through markets, portfolios aren't just exposed, they're unknowingly leveraged. The Wall Street Journal's investigation didn't just expose the loans, it exposed the blind spots in how we measure risk today. Source: Wall Street Journal 2024 investigative report. So what's the fix? For investors, demand transparency. Forced disclosure not just of top-line growth but of asset-backed liabilities and cash flow projections. For regulators, treat private debt like public, size it, stress test it, and shine a light on mismatches before they metastasize. The clock is ticking. Markets move faster than audits, and when the next shock hits, the question won't be who knew, it'll be who acted. Stay ahead, stay skeptical. Subscribe button pulses on screen. Source: U.S. Securities and Exchange Commission Tesla 2023 10K filing. Source: Bloomberg Starlink's debt structure exposed, 2024. Source: IMF World Economic Outlook, April 2024. Source: Wall Street Journal SpaceX's $15 billion Starlink loans under scrutiny, 2024. Source: Reuters SpaceX bonds at 7.5% yield signal investor caution, 2020.